You've probably paid this company money, you've never heard of it, and right now its own investors are suing it. If you've ever gotten a red light ticket in the mail or rented a car and later received a toll violation you didn't know about, there's a good chance you were interacting with a single publicly traded company most people have never heard of. It runs nearly every speed camera and red light camera system you've ever driven past. It handles the toll billing for almost every rental car company in America, and on May 26th, 2026, it lost 71% of its value in a single day. Not because of some market crash, not because of a scandal, but because one customer decided to leave. I spent the last 3 weeks digging into this company, reading their SEC filings, reading the actual lawsuit, looking at the earnings calls, and what I found is a story about how a company can build a near monopoly around something you probably resent, become incredibly profitable doing it, and then nearly destroy itself because it became too dependent on one relationship it told investors was completely safe. I'm going to walk you through exactly how this business works, why it's structured the way it is, what actually happened on May 26th, and why the part of the business people hate the most is the part that's actually fine. Let's go. Verra Mobility Corporation, Nasdaq VRRM. If you've seen their cameras, you know the flash. What you probably don't know is that this is a nearly billion-dollar company with 1,600 employees, operating in 11 countries with over 10,000 camera systems deployed. They went public in October 2018, and in fiscal year 2025, which ended last year, they did $979.1 million in revenue, up 11.4% from the year before. Net income, $136.6 million. Cash from operations, $255.8 million. These are not small numbers. But here's where it gets interesting. This company operates in 3 segments, and you need to understand all 3 to understand what happened. Segment 1, government solutions. This is the one you probably think of. Red light cameras, speed cameras, school bus stop arm cameras, bus lane enforcement. They run these systems for cities and school districts across the country. You break the law, their camera catches you, the ticket gets processed, the city gets its revenue, Verra gets paid. Segment 2, commercial services. This is the one you've definitely interacted with, but never knew existed. Automated toll and violation billing for rental car companies and large fleets. You rent a car from Avis or Hertz, you drive through a toll, you don't have a transponder. The toll authority sends the violation to the rental company sends it to Verra. Verra figures out who you are, processes it, bills you, handles the disputes, manages the whole mess. This is not a small business. Verra has 54 separate toll authority relationships across the United States. Segment 3, parking solutions. Parking software and hardware for universities, municipalities, hospitals. The app you use to pay for parking at the hospital or the university lot, that might be them too. Now here's the number that matters. The commercial services segment, the toll billing paperwork business, operates at a 66 to 67% profit margin. Let me say that again. Processing toll violations and billing rental car customers has a higher profit margin than almost any physical business you can think of, higher than software, higher than most pharmaceutical companies. This is paperwork and it's printing money. But here's why this matters for the story. Verra didn't build this business organically, they bought it. In 2021, they acquired a company called Redflex, which gave them the red light and speed camera technology. Also in 2021, they acquired T2 Systems, which gave them the parking business. They assembled a portfolio of annoyances and they turned it into a profit machine. Now let's talk about the monopoly part, because this is where it gets structurally interesting. And I want to be clear about what I mean by that. I'm not saying this is an illegal monopoly. I'm saying it's a business that's incredibly hard to compete with and incredibly hard for its customers to leave. On the commercial side, those 54 toll authority relationships are described in the lawsuit as highly complex. And that word matters. Toll authorities across America all have different rules, different systems, different timelines, different dispute processes. If you're Avis Budget Group and you have millions of rental transactions a year across dozens of states, building an in-house system to handle all of that is a massive undertaking. Verra has spent years building these integrations. They know the systems, they know the people, they know the edge cases, and that's exactly why rental car companies pay them instead of doing it themselves. It's not that Verra is the only company that could do this, it's that the switching costs are enormous and the complexity is real. On the government side, it's a different kind of lock-in. Verra just announced a new 5-year contract with New York City's Department of Transportation for red light camera expansion. That was announced February 24th, 2020. 2026, the same day as their earnings. They were also selected by the LA City Council for a speed camera pilot under California's AB 645 law, 125 locations targeted by the end of 2026, the largest speed safety program in the state. That was announced in July 2026. When you're a city and you're deploying hundreds of cameras and you need someone to maintain them, process the violations, handle the legal challenges, manage the data, you don't switch vendors lightly. The contracts are long, the systems are integrated, the institutional knowledge is deep. So you have this structure. Half the business is a near monopoly on catching you breaking traffic laws. The other half is a near monopoly on billing you when you rent a car. Both sides are quietly one of the most profitable arrangements in what they call smart mobility. And for a while, this looked like a machine that just kept running. Now here's where the tension starts to build. February 24th, 2026. Verra reports their fiscal year 2025 results. $979 million in revenue, $136 million in net income. Solid numbers. And they issue guidance for fiscal year 2026. According to the lawsuit, management characterizes the commercial services business as durable. The fundamentals are described as solid. The implication is clear. This is a stable, predictable business. The kind of business you can model out. The kind of business where the customer relationships are secure. Now, I need to be precise here. The lawsuit is written by plaintiffs' lawyers, and their job is to make management look as bad as possible. So when they say management described the business as durable or the negotiations as ongoing and constructive, those are the lawyers' characterizations of what was said, not necessarily verbatim quotes. But multiple law firms, Levi and Korsinski, Hagens Berman, Kaplan Fox, Sewall, all independently describe the same framing. So the general sentiment is not in dispute, even if the exact words are. This February 24th call is also the start of what the lawsuit calls the class period. February 24th to May 26th, 3 months. That's the window where investors who bought the stock are now alleging they were misled. So let's talk about what happened in those 3 months. Here's what we know from the outside. Nothing. The stock traded normally. There were no press releases about customer issues, no hints of problems. If you were an investor watching this company, you saw a business with 11% revenue growth, 67% margins in its commercial segment, new government contracts being announced, and management telling you the fundamentals were durable. Why would you think anything was wrong? But here's what we now know was happening underneath. Verra's biggest commercial customer was Avis Budget Group, and I don't mean one of their biggest. I mean over 10% of Verra's total revenue, probably more, ran through this single relationship. When one customer is that significant and that customer is a sophisticated corporation like Avis, you can bet there are constant conversations about the contract, about pricing, about terms, about the future. According to the lawsuit, the Avis relationship had been running on what's described as a short-term contract extension. The long-term deal had apparently expired, and they were operating on extensions while negotiations continued. And according to multiple law firms' characterizations, management was telling investors those negotiations were ongoing and constructive. Let me pause here and say something directly. I don't have the internal emails. I don't have the board minutes. I don't know exactly what management knew and when they knew it. The lawsuit alleges they knew more than they said. Verra will presumably argue they disclosed what they were required to disclose. That's what the legal process will sort out. But what I can tell you is what was public and what happened next. May 26th, 2026, after the market closed, Verra files an 8K with the SEC. The headline, they received a termination notice from Avis Budget Group effective September 2026, 4 months away. Let me walk you through the math on what this meant. The company had just told investors 3 months earlier that fiscal year 2026 revenue would be around a certain number. Now they were cutting that guidance by about $35 million at the midpoint. That doesn't sound catastrophic until you realize that $35 million in a business like this is almost pure profit. At 67% margins, you're talking about $23 million in net income just vanishing from the forecast. But the market didn't just react to the guidance cut, the market reacted to the story, because this wasn't, we lost a small customer. This was our largest commercial customer. The one we told you was stable, the one we implied was locked in, just told us they're leaving. The durability narrative collapsed in a single filing. The stock closed on May 26th at $13.08. It opened on May 27th at $3.85, a drop of $9.23 per share, a 71% collapse in a single session, not over a quarter, not over a year, in one day. Now let's put that in context. This is not a startup, this is not a crypto token, this is a nearly billion-dollar revenue company that had been public for 7.5 years, and it lost almost 3/4 of its value because one customer decided not to renew a contract. That is an extraordinary level of concentration risk, and it raises an obvious question. If this relationship was so fragile, why didn't investors know? 6 days later, June 1st, 2026, CEO David Roberts departs. The company announces a leadership transition. The language is polite, the timing is not. 6 days after the biggest single-day collapse in the company's history, the CEO is out. Make of that what you will. Now let's talk about the lawsuit itself, because this is where the accountability part comes in. On behalf of investors who held VRRM stock between February 24th and May 26th, a securities class action was filed. The core allegation is straightforward. Management's public statements about the durability of the Avis relationship, the likelihood of renewal, and the achievability of 2026 guidance were materially misleading given what the company knew internally. But here's the detail that matters. 2 senior executives who personally certified Verra's SEC filings are named as individual defendants under Section 20A of the Securities Act. This is not just sue the company and the insurance pays. This is the people who signed the documents are personally on the hook. That's a different level of legal exposure, and it's designed to make executives think very carefully about what they sign. Now, I want to say something about the class action bar, because it's its own little ecosystem. Within days of the May 26th collapse, no fewer than 6 major law firms had issued press releases announcing investigations or filed complaints. Levi and Korzinski, Hagens Berman, Kaplan Fox, Kirby McInerney, Sue Wall Street, others. They're all competing to be appointed lead counsel, which means they'll control the litigation and earn the fees. This is not a coincidence. This is a business model. These firms monitor for large stock drops, they file quickly, they compete for the class, and if they win or settle, they take a percentage. It's usually around 25 to 30% of the recovery, which in a case this size could be tens of millions of dollars. I'm not saying this is good or bad. I'm saying it's a system that shows up like clockwork after every collapse, and it's part of the infrastructure of American capital markets, whether you like it or not. The lead plaintiff deadline in this case is August 4th, 2026. That's the deadline for investors who lost money to come forward and seek to represent the class. If you're watching this around that date, that's what's happening behind the scenes. Now here's the twist, and this is the part I find most interesting about this whole story. While the commercial services side of Verra's business was collapsing, while the stock was cratering, while the CEO was leaving, while the lawsuits were being filed, the government solutions side kept expanding. The NYC contract wasn't paused, the LA program wasn't delayed, the cameras kept flashing, the tickets kept getting processed, the money kept flowing. Think about that for a second. The part of the business that bills you for breaking a traffic law is more insulated than the part that bills you for renting a car. The red light cameras don't care what happened to the stock price. The speed cameras don't care that the CEO left. The school bus stop arm cameras don't care about the lawsuit. They just run. And this gets at something deeper about this company's structure. Government contracts are long-term. They're signed after competitive bidding processes. They have termination clauses and notice periods. You can't just wake up one day and decide to switch vendors. The city has to go back out to bid. The new vendor has to deploy new hardware. The old vendor has to hand over data and systems. It takes months, sometimes years. Commercial contracts are different. Avis is a sophisticated counterparty. They can make a calculation that it's worth the switching costs to bring this in-house or find another provider. They can absorb the short-term pain for long-term gain. They don't have to go through a public process. They just have to send a notice. So you end up with this strange situation. The part of the business that people resent, the cameras, the tickets, the enforcement, is stable and growing. The part of the business that's more invisible, the toll billing, the back office processing, is where the risk was concentrated. And that's not an accident. That's a reflection of how different types of customers behave and how different types of contracts work. Let me wrap this up with what I think is the actual lesson here. Verra Mobility looked like a boring, predictable business. Tolling paperwork, traffic cameras, parking apps, the kind of company that doesn't make headlines, just makes money. And for a while, that's exactly what it was. 11% revenue growth, 67% margins, $255 million in operating cash flow. The machine just kept running. But underneath that boring exterior was a concentration risk that almost no one was talking about. When over 10% of your revenue comes from one customer, and that customer is sophisticated enough to leave, and your whole narrative to investors is about how stable and durable those relationships are, you are one notice letter away from catastrophe. That's not a black swan. That's a structural vulnerability that was visible to anyone who read the 10K closely enough. And the irony is that the part of the business everyone hates, the cameras, is the part that's actually fine. The government contracts are long-term. The need for enforcement doesn't go away. The revenue is recurring and predictable. It's the boring commercial services business, the toll processing, the back office work, that turned out to be the house of cards. So the next time you get a red light ticket in the mail or a toll violation from a rental car, take a look at who's processing it. There's a reasonable chance it's Verra Mobility, a company you've never heard of, a company that was quietly making hundreds of millions of dollars from those interactions, a company that lost 71% of its value in a day because it bet too much on one relationship it told everyone was safe. The camera doesn't care what happened to the stock price, but the investors who lost 3/4 of their money sure do, and now they're going to spend years in court trying to prove they were lied to. That's the system, that's the process, and that's what happens when a boring business turns out to be anything but. If you want to go deeper on this, I've linked the actual SEC filings, the 8K from May 26th, and the law firm complaints below. Read them yourself. The facts are public, the timeline is clear, the only question left is what the court decides. I'll see you in the next one.